At this point in time, let's talk about the yield curve and the economy and how it relates to the lodging sector. Please welcome to the stage Adam Sachs, President, Tourism Economics.
Well, it's good to be with you. I have the challenge of basically telling you when the downturn is going to happen, right? So the previous panel telling you be prepared. All I have to do is tell you when it's going to happen and how bad it's going to be. That may actually extend beyond my skill set and my pay grade. But what I am going to do is give you our view on what's going on in the world of travel, what's going on in the economy, and how we see that evolving, and what we think the risks are. And I will be candid about what we think the likelihood of a recession is and the timing of that. I'm going to try to leave most of the specifics about the lodging industry and what's going on there in terms of performance to my friend Jan Freitag, who's speaking tomorrow morning from STR, as well as Mark Woodworth from CBRE. They're going to get into the data of that. I'm going to try to give you a foundation for that session tomorrow morning. So let's get into it, starting with what has happened in travel. You know, we can think about our industry from the supply side, what's going on in the industry, and rightly so. But I think it's equally vital to think about what's happening with the traveler, right? What is happening with our customer and the demand side? Well, if you look at the last 8 quarters of growth, 2017 and 2018, there are a couple of things that stand out. If you look at 2017, what you see is that people are flying and staying in hotel rooms at about the same rate of growth. You know, it bounces around quarter to quarter. But the rate of growth within passengers getting on airplanes and people staying in hotel rooms was about the same for 2017. Not so in 2018. In fact, in 2018, people began to fly at a much greater rate than they stayed in hotel rooms. What does it tell us? It tells us that people were traveling further to get to their final destination than they have been in 2017, and indeed in the previous few years as well. Now, there's another trend that's happening at the same time, which is within 2018, if I look at domestic versus international demand, we see international every single quarter in 2018 successively slowing down, while domestic air passenger growth actually kept along the same pace throughout the entire year. And so what that leads us to is a conclusion that domestic was truly the wind in the sails of hotel room demand in 2018, as opposed to international visitors coming and spending nights in hotels. And what's remarkable about 2018 is that in terms of international travel to the US, it didn't look like anything we've seen in the last decade, right? And that is not hyperbole, because the biggest driver of growth of international hotel room demand over the last decade has been Asia, right? It has been Korea, and it has been China in particular. Well, Asia actually contracted in 2018. Europe has been very much bumping along the bottom, but Europe actually picked up a good bit. Latin America recovered. Overall, overseas travel to the US increased just 2% last year, which is significantly slower than it typically has. And there are some interesting culprits behind this subpar and uneven growth in international travel to the US, noting that Germany contracted by a wide margin in 2018. Less surprised by Japan flirting with recession and Venezuela deeply entrenched in a recession, but very surprised that China, after posting annual growth of over 20% per year over the last decade, came to an absolute standstill in travel to the US last year. Korea actually contracted after growing on average 15% a year over the last decade. Right, so these are big changes within the international market. And if you just want to pan out and think about this, why is this happening? I think there are a number of reasons, but probably the most fundamental one is that the US is just more expensive than it's been over the last 5 years. If I index exchange rates to 2013 and then let them go, you see how much more expensive the U.S. has become to travelers around the world over this 5-year period. Now some 42% more expensive, priced in Brazilian real. Some 35% more expensive in Mexican pesos, 20% more expensive for Canadian dollars, and about 14% from the UK. And so when you think about ADR in the industry for our international travelers, thinking about it in terms of international currencies can be a little bit more instructive in terms of how much more expensive the U.S. has become. But the overall effect, over the last 2 years, overseas travel to the U.S. growing just 2% in each year, compared to the previous 5, growing on average over 6% a year. So this is a big shift in terms of where are we seeing our customers come from. Nevertheless, hotel room demand is continuing, not only in absolute terms, to hit new peaks time and time again, but to hit new peaks on a per capita basis. Behaviorally, U.S. households are spending more nights in hotel rooms than they ever have before. Now, this is an uber trend, right? I'm looking at data here back to 1987, right? And so clearly this is something that is reflective of rising incomes and changes in behavior. But I think notably, since about 2014, we've gone even above that trend. And now we're seeing people spending more hotel rooms, more nights in hotel rooms than ever before, and above the pace of that long-term kind of gradual increase that we've seen. So this is important, and I think helps to inform where we think things are going. Because this behavior is not just in terms of nights, it's in terms of spend. Look at the last 7 years of how Americans spend their money and how that has changed. So again, indexing here just from the end of 2011, and you see that spending on lodging among U.S. households has grown 45%. Right, compare that to overall consumer spending that's grown just 30%. Now, it's clustered with other things that you might consider to be associated with travel. Food and beverage up 44%. Recreation services up 36%. But clearly, our industry is taking up more and more share of consumer spending. It was mentioned earlier in the session that we are in the golden age of travel. One of the ways we can look at this is how is the travel industry performing relative to the rest of the economy. So I looked at the top 100 cities in the US, and I looked at growth and employment over the last decade in leisure and hospitality, that's on the left axis, compared to total employment growth over that same period. Well, in 95 out of the top 100 cities in the US, leisure and hospitality employment has outpaced growth of total employment in the economy. If you, from a policy advocacy standpoint, there can be very little that's more powerful than this. We are creating more jobs than the rest of the economy, increasingly so. And it has important implications as you think about where this industry is headed. There are going to be cycles. But over the long run, we are in an industry that has traditionally continued to outpace the rest of the economy. Now, this recovery has indeed been won by transient demand. Right? If you look at growth since 2008, actually group room demand has contracted, whereas transient has grown some 47%. So that aligns really well with the idea that it's consumers and their behavioral shift of spending more and more money on lodging that has driven this 10-year run that we've been on. And so it's not surprising if you look at this data on a day-by-day basis, and again, you index to 2007 to see which days are winning this race. It is Friday and Saturday that are well above their peers in the weekdays. So long live weekends. Okay. But I don't think we need to kick groups to the curb, because we've actually seen a revival in groups. And what's fascinating, if you'll indulge me as an economist, what's fascinating to me is that group room demand moves lockstep in line with the way that businesses spend on capital investment, capital goods. And it stands to reason, right? The same things that are going to motivate spending on conferences, conventions, trade shows, incentives, such as corporate profits, right? Expectations about the future, overall company performance, consumer confidence, these sorts of things. Those things are driving the same decisions to participate in those conferences in the same way they're driving decisions to invest in new equipment, new machinery, new plants. And so we see these things moving together. And last year, capital investment in the US, companies' investments, rose some 7%, right? And so it was not surprising to us to see group room demand begin to lift, right? And capital investment, we believe, has legs. It's going to soften, but we believe it has legs. And so group room demand continues to be a force. And its demise that was spoken of so emphatically some 9, 10 years ago, in the trough of group room demand, was highly exaggerated. All right, so what is this? Where do we think we're headed? Where do we see the economy? Where is it going? What are its risks? Well, big picture, the global economy is cooling. When I look at world GDP and purchasing managers' indices, both of them, and these are good leading indicators of where we're headed, both beginning to soften around the world. Nevertheless, emerging markets are setting the pace, growing over 4%, while developed economies growing just about 2%. But you can see both, whether I look at the developed economies or the developing economies, both set to slow somewhat in 2019, and then developed economies to slow further in 2020. But here's the critical point as you hear more and more about this impending slowdown, is that the US is far outpacing its G7 developed economy counterparts. US, in 2019, we expect to grow about 2.2%. I mean, compare that to other developed economies and feel some sense of encouragement that we're in a market that is doing really well compared to other developed economies. We ask our clients every quarter, what do you see as the #1 risks to our forecast? So we, Tourism Economics, our parent company Oxford Economics, produces monthly forecasts on the global economy and on travel. We asked them, what do you think the downsides are, or the upsides to this forecast? Well, I think what's interesting is if I compare what people said at the end of 2018 and what they said in the first quarter of 2019, we see a bit of a reduced concern about the trade war hitting global growth, but it remains the #1 risk in our global client base's mind. Right? Followed by market turmoil. So certainly, as we saw a lot of volatility in December, continued volatility and sideways movement in January, that remains a concern as well. The reason that I can be fairly definitive about the US economy slowing in 2019 is because a significant part of the boost in 2018 were the policy initiatives of tax reform and the spending bill. The boost from both of those policies will abate in 2019. And so we do expect a slowdown. And I think that's, the extent of that slowdown is really where the debate comes in. But I think the critical thing to note is that you still do see some boost from these policies in 2019. You see almost none in 2020. All right. Business investment is also poised to cool. There are a number of reasons for that. I think the rationale is strong. Domestic demand is moderating. Those incentives and deregulation benefits are diminishing. Financial conditions are certainly tighter now than they were a year ago. And as I mentioned, global growth is slowing. All of those are tending to push against businesses investing. But confidence is still pretty high. The NFIB Small Business Optimism Index, you can see that it's dipped a little bit over the last couple of months, but it's still, pretty much where we would hope it to be at this place in the cycle. But notably, uncertainty has also risen at the same time. A lot of that has to do with uncertainty about the trade war with China. It also has to do with uncertainty with how the Fed is going to behave. However, you may have seen that just today, the Fed was pretty clear that they do not expect to raise interest rates further in 2019. Why is that? Well, one, it's because of some of these signs of weaknesses that we've been talking about. But I think more fundamentally is that inflation is well under control. Even at this point where we are in the cycle with unemployment at historically low rates, and wages beginning to firm, we don't see inflation picking up. And so that gives the Fed the freedom there not to raise rates. Lower gas prices are part of that inflation picture, but of course they help our customers as well, freeing up disposable income to travel and to stay in hotel rooms. Consumer confidence, it remains strong. We've seen that dip in recent months. The government shutdown had a lot to do with that in the most recent data. We expect that to come back a bit in the next couple of months. But still, we are above where we were at kind of peak levels more than a decade ago. The foundation of that, and I would extend that to say the foundation of why the US economy remains on good footing, is because wages are growing. What I'm showing you here is just a dot plot of what's been happening over the last decade or so on unemployment rate relative to wage growth. And what you see, not surprisingly, is that as you go quarter to quarter to quarter, as the unemployment rate, can you even remember that it was 10%, touching close to 10% at the trough of the Great Recession? But as the economy began to heal and the job market began to produce positions and the unemployment rate began to come down, eventually, and we've seen this particularly over the last year, wage growth began to accelerate. Most recently, seeing wage growth ticking up to 3% annually. That is probably the most encouraging thing that we can see about the US economy. So then, this is kind of the elephant in the room, right? Is a recession overdue? We are now just, I believe, 1 month away from the longest expansion ever on record for the US economy, right? And it kind of makes you feel like, well, then we must be due, right? But the thing is, there's no such thing as an expiration date on an expansion, right? There needs to be a cause. That cause has to be some bubble, right? Some inflation of asset prices or an external event that triggers a spiral of confidence, right? Neither of those things is self-evident at this point. And the reality is that expansions are the norm. They're not the exception. And I would offer this added word of comfort is that when we do see a downturn, it's extraordinarily unlikely that it'll be as severe as the one that we experienced a decade ago, which was a generationally unique, financial-induced recession. The odds this year are extremely low. Why do I say that? We at Oxford Economics track a high-frequency indicator of the recession probability. It's this blue line. You can see that wherever you see a recession in history going back to the late 60s, that blue line has tended to spike over 50 in advance of that happening. This blue line is a function of the yield curve and of the federal funds rate and of economic activity. And right now, we're not even touching 30. So we really don't see anything around the corner that would predicate some sort of a downturn. The odds go up in 2020, to be fair, because as all the benefits of tax reform and the spending bill really are in the rearview mirror, that does put the US economy more susceptible to an external event. Our leading indicators for travel are showing the exact same thing when we look at forward bookings. How are people booking, either for air travel or vacation intentions surveys? What are they saying or doing over the next 3 and 6 month periods? Well, both are showing a bit of a slowdown relative to the past year, but still growth. In this index that we prepare for the US Travel Association, anything over 50 is growing, which is telling us that we should see continued growth in room demand over the coming year. Air travel bookings, this is forward-looking data 3 and 6 months ahead. Right? So bookings made in January for the next 3 and 6 months. You can see that you're actually looking at growth at some 5–6%. So people are far from shelving their travel plans. In fact, if I look at vacation intentions, I get even more reason for a positive outlook, because in December, 2018 intentions of households saying they were going to take a vacation over the next 6 months were higher than they were a year ago. And then when I jump into January of 2019, you can see that it's well higher than we were in January of 2018 or January of 2017. What is it telling us? It's telling us that the effect of those wages flowing into consumers' pockets and that continued behavioral shift is continuing to pay dividends and will so into this year. But I don't want to create the impression that we're taking off here. We see it as settling, in fact. And in line with GDP growth, we see room demand also settling. This is the forecast we produce each quarter with STR. And what you can clearly see is that as we expect GDP to cool over the next 2 years, that room demand will also step down in terms of its pace of growth. What's encouraging, and I think probably encouraging for you in this room particularly, is that room supply has leveled off. And what's interesting, if you look at the long-run history back to the late 80s, you can see that the industry has had this kind of awful habit of adding rooms, and a lot of them, at just the wrong time. Right? These gray areas of recessions. You can see that room supply, in the 4 to 5% for the years before the 1991 recession, and then peaking in the late 90s again before the recession in the early 2000s. Of course, room supply growth peaked at another 3% right in the midst of the Great Recession in 2009. But here we are, no recession, and we've leveled off at around 2%. And so our ability to withstand the effects of a recession are much better than they have been in these previous 3 recessions. Of course, in certain markets, supply increases are notable. And I'll just call out that in New York, you're looking at some 11% of room supply that is under construction right now. Nashville, continue to defy all laws of gravity with 8% growth in the pipeline, but not what it was a year ago, fortunately. And so clearly, market by market, there are going to be challenges to absorb this supply. But nationally, just about a 2% and beginning to taper down in terms of room supply growth over the coming couple years. So what it leads us to, if you put all this together in kind of one package, demand beginning to soften, right, while supply is kind of in that 1.9 to 2% range. As you go into 2019 and 2020, we need to become accustomed to an environment where our RevPAR gains are entirely rate related. And so you can see that our forecast with STR now predicts a 2.3% gain in rate in 2019, but no gain in occupancy. Basically, demand and supply matching each other in terms of their increase in 2019. In 2020, you're going to have a bit of a drag on occupancy. Right? If demand does, as we expect, taper a little bit further, it's going to go a little bit below the rate of growth of supply. So occupancy falls just a bit, but there's still rate gains to be realized because occupancies are so high. Because occupancies remain at record levels, the ability to raise rates, because there are going to be nights and periods of time in markets where there's going to be serious price pressure, and that will continue to be opportunity on the bottom line. So you would be right to ask me how accurate are these outrageous forecasts that I've been telling you for the last 15, 20 minutes, and the answer is pretty darn accurate most of the time. All right. So this is our our full revelation of what we've been doing with ourselves for the last 5 years, and this is in each year what Tourism Economics and STR forecast at the beginning of the year in January, and then what happened in terms of RevPAR. So in 2015, in January, we forecast RevPAR would grow 6.4%. It came in at 6.2 a year later. When I say most of the time, my big caveat is probably 2016. That's where we missed by the widest mark. Directionally correct, of course, but it didn't turn out quite as well with 5% not hitting that 5% mark. But then the last couple of years, really, really close. And so coming in last year at 2.9%, actual RevPAR compared to our January forecast last year of 2.7. So you can do with that what you will in terms of how much stock you put on everything that I've said so far. But let me end with just some concluding remarks to try to summarize everything that we've talked about. The first thing to remember is that the world economy is indeed slowing. Right, and that is true around the world. It is true in the U.S. However, the U.S. is outpacing developed economies around the world. Right? It's premature to call for a world recession. Right? Don't buy into the fear. All right, be prepared by all means, but there's nothing that's saying this is an inevitability over the next 12, 18 months. The key risks, of course, to keep our eyes on, the unresolved trade war with China, financial turmoil, a disorderly Brexit, certainly will have some ripple effects if that goes on. Inbound travel to the US, we're fairly bearish on right now. So it's our view is that most of the demand in terms of both rate of growth and in terms of absolute volumes, to be sure, is going to come from domestic markets. And all that we're seeing in terms of consumer confidence and wages and behavior give us some encouragement that there's more opportunity for us throughout the year. So thank you very much for having me. It's been a pleasure.